Okay, Friday morning, pre-market screen is lit up. S&P 500 futures, ES, they're tracking up 0.2%.
And the Nasdaq 100, the NQ, is leading that momentum, up about zero point 0.4. So on the surface, the tape looks green.
It looks inviting, right? It looks like it's just carrying over from yesterday's big earnings beats.
Exactly, but if you peel that back, the mood on the institutional desks is, well, it's decidedly neutral.
And that's the paradox, isn't it? We're seeing this low-volume holding pattern ahead of the long holiday weekend.
It's a profound tug of war. On one side, you have this incredible residual momentum from, historic CapEx numbers, billions. But on the other, there's a very clear de-risking campaign happening, and it's all driven by macro fear and, frankly, some political noise.
So that's our mission for this deep dive, Zen, unpacking how the market can look technically positive but feel so fragile underneath. It's this friction between, say, AI infrastructure momentum and the structural pressures from yields and what's going on at the Fed.
You have to appreciate that tension. It's narrow, highly capitalized sectors like semis fighting a massive slowdown signal from the traditional economy.
And you mentioned a political clash.
A big one. Our sources are saying it could genuinely jeopardize the whole 2026 soft landing scenario we've all been banking on.
Okay, so let's start there with that slowdown signal. What's causing this caution despite the green futures?
It's the classic canary in the coal mine. We have a freight recession staring us in the face.
A freight recession.
Yeah, the caution is coming from a huge earnings miss from JBHT. They're down about 4% pre-market. And the reason is contracting volumes. That's the key.
Explain that for us. Why is one transport company's miss such a big deal for the whole market narrative? Why is freight the canary?
Because freight is the literal lifeblood of the industrial and consumer economy. When you see a player like JBHT miss, it's not just some isolated logistics issue.
It's a signal.
It signals a stalling industrial economy. It means goods demand is slowing significantly. Either businesses are just running down the inventory they already have, or they're not placing new orders because the final consumer demand just isn't there.
So it paints a picture of the economy completely outside of tech and AI, and that picture is not pretty.
Not at all. It's slowing and maybe dramatically.
Okay, that context is vital. Now, speaking of structural health, we also have regional banks reporting. PNC is on the docket. Big bank beats were all about Wall Street, right? Trading, M&A.
Exactly. PNC is the check on Main Street. The rally we saw in Goldman and Morgan Stanley was all M&A advisory fees, trading revenue, Wall Street stuff.
Right.
Regional lenders like PNC, they're dealing with the real economy. High interest rates, deposit flight, risk in their bond portfolios.
Right.
If PNC shows contracting loan growth, it tells you the party on Wall Street is not translating to the rest of the country.
And here's where it gets really interesting, tying this all back to that institutional uncertainty you mentioned. We got confirmation just ahead of the open. The DOJ is officially subpoenaing the Fed. Now, I get why that makes people nervous, but how does that political fight actually translate to caution on a futures desk this morning?
Because this injects a huge level of non-economic risk right into the central bank's operations. The Fed's #1 job is supposed to be monetary stability.
And this distracts them.
It completely diverts their focus. If Chair Powell and the board are suddenly buried in legal compliance and investigations, they're not focused on the inflation fight or, navigating this incredibly nuanced path to normalizing rates.
So the market sees this as a potential wrench in the soft landing machine.
Precisely. Our sources see it as a serious headwind. It could jeopardize that 2026 soft landing path by just slowing down decision-making. That's another layer of risk, and it's absolutely contributing to that neutral sentiment heading into a long weekend.
Okay, that context is crucial. Let's pivot now from the macro catalyst to the technical battlefield. You said the market is coiling. What does that mean, and what are the key levels we need to watch? And just for anyone listening, what are those futures contracts?
Right. So when we say coiling, we mean volatility is compressing at these really high price levels. It's like a spring being wound tight.
A tug of war.
It's that exact tug of war. Strong earnings are the floor, but the hawkish macro story is the ceiling. And we're stuck. The key contracts are the S&P 500 futures, that's ES, and the Nasdaq 100 futures, or NQ.
Okay, give us the line in the sand for the S&P, for the ES.
The battle is for 7,000. That's the number. Resistance is stacked really heavy between 7,000 and 7,015. We're calling it the Maginot Line.
The psychological barrier.
That's while the institutional sell orders are sitting, just waiting. If the bulls are for real, we need to see a clean 15-minute close above 7,015, and it has to be on volume. That would open up a road to 7,100.
And the safety net, what's the must-hold level on the downside?
Support is between 6,895 and 6,850. But the absolute critical line is the 20-day moving average. Right now, that's at 6,856.
And why is that so important?
Institutions see that as the key indicator for the intermediate uptrend. If we can't reclaim 7,000 by midday and we break that 20-day, you can expect a classic Friday fade. Traders will just de-risk and dump positions before the weekend.
Now, looking at the Nasdaq, the NQ, you said it's no longer a rising tide trade. It's a stock picker's tape.
But
What's driving that shift?
it's all about narrow leadership. TSMC's announcement of just a massive $56 billion CapEx plan is almost single-handedly propping up the entire chip sector.
So it's not the whole Magnificent Seven anymore.
Their momentum is flagging. The money is concentrating in companies directly plugged into the AI build-out. General software, other tech, it's getting left behind. The index you need to watch isn't even the Nasdaq, it's the SOX, the semiconductor index. If semi lead, NQ follows. But it's very conditional.
Which brings us to this liquidity trap idea. We're near all-time highs, but volume is thin. How do you trade that without getting caught out?
Well, with that volatility compression, the market is just hunting for stops. It's going to make aggressive fake moves above or below key levels just to shake people out.
So chasing that 9:30 a.m. pop is a bad idea.
It's pure speculation today. The strategy has to be patience. You have to wait for acceptance.
Acceptance.
Yeah, you need to see volume-backed consolidation above or below those key levels. You need to see institutions confirm the move, not just a quick spike on thin retail volume. Today is about preserving capital. Confirmation, not assumption.
Let's get into where that smart money is flowing then. This is a sector bifurcation story, so starting with the strongest pocket, semiconductors.
The conviction in the SOX index is absolute. And what's wild is how TSMC just completely nuked the AI bubble narrative with that 2026 CapEx guidance, $52 to $56 billion.
Which is way above expectations.
It's 15% above the highest Wall Street estimate. It's a massive statement.
But hold on, isn't that much CapEx usually a warning sign? A signal of oversupply coming down the pipe?
That is a critical question, and it's why every analyst is scrambling. Normally, yes, massive CapEx signals a future glut. But what TSM is confirming here is a CapEx arms race.
An arms race.
It's driven by long-term, multi-year strategic commitments from huge companies. This isn't just about the next PC cycle. This implies durable, healthier demand for cutting-edge AI chips than any of the bears thought was possible.
Let's use TSM itself as a marker then, key levels.
TSM is the driver.
Yeah.
For the bulls, it has to break above $345. If it does that, momentum is just overriding everything. The high volume support, the line for the bears, is $313. A slip there, and the market will say it was all priced in.
Okay, next up, financials. Morgan Stanley had a huge beat.
MS is key because it's about behavior. Their beat was fueled by a big comeback in M&A. Deals were up 65%.
Right.
Institutional desks read that as the animal spirits returning to the boardroom. Corporations are finally confident enough to start making big deals again. If MS can hold above $118 today, it confirms that narrative.
And to round it out, Micron, MU, it's getting a direct boost from that TSM news.
MU is seeing huge pre-market volume, over 326,000 shares. It's the TSM read-through and tightening supply in high bandwidth memory, HBM.
The specialized AI memory.
Exactly. If MU can clear $360 on volume, that tells you the memory cycle is entering what we call a super squeeze phase.
A super squeeze, break that down. Is that real demand or just shorts getting squeezed out?
It's both, but it's driven by real demand. A super squeeze happens when the big money realizes supply of something like HBM is critically tight while demand is going exponential. So if the stock pushes through a key level like $360, all the short sellers have to buy back their shares, and that just adds fuel to the rally. A positive feedback loop.
Okay, so recapping the strategy for the open, wait out the first 30 minutes. If semis hold their gaps, ride the trend. If the regionals like PNC BIS, look for rotation back into mega cap tech for safety.
Be nimble. Be ready for that rotation. But we have to connect all this excitement back to the gravity of the macro environment because it's tightening the noose on growth stocks.
Let's talk about that gravity. Yesterday's labor data was a bit of a surprise, wasn't it?
It was strong. Jobless claims came in hot at under 98K. That just tells you the labor market is still simmering, and it kills any hope the market had for a quick Fed pivot. It's higher for longer, period.
Which directly hits the 10-year Treasury yield. It's near 4-month highs.
Yep. The 10-year, the TNX, is at 4.17%. The dollar index, DXY, is strong at 99.31. For growth stocks, this is a firm headwind.
Explain that connection for everyone. Why does a higher 10-year hurt tech stocks so much?
Think of the 10-year yield as the risk-free rate. It's the baseline. So every tick higher in that yield compresses the valuation multiples for growth stocks. It's a rising discount rate that just eats into the value of their future earnings.
Okay, that brings us to the pain trade alert you flagged. Who is most at risk from this macro tightening?
It's the retail traders who are currently all in on this AI momentum trade, purely off the headlines from TSM. They're ignoring a huge metric,
Which is,
duration risk.
let's make that tangible. What is duration risk in simple terms?
It's just the risk that rising interest rates will hammer your long-term assets. Retail is focused on the next quarter's earnings. Institutions are looking at the structure. If the risk-free rate from a treasury becomes more attractive than owning a high-flying tech stock with no dividend, they will rotate. They sell that long-duration risk and buy short-duration safety.
So what's the immediate danger zone, the specific level to watch today?
The danger is precise. If the 10-year yield breaks 4.2% today, institutional money will start hedging aggressively. You can see a sudden, violent rotation out of high-beta tech. Retail gets trapped at the top while the smart money runs for cover. The 10-year is the most important metric to watch today.
So wrapping it all up, what does this mean? We have these strong but very narrow technicals from TSMC pulling up the whole chip sector, but that's fighting an equally strong macro gravity. The 4.17% yield, sticky labor, and this DOJ-Fed tension.
Today's about capital preservation. You have to recognize the extreme bifurcation. Don't let the excitement in one sector blind you to the macro clouds. The lesson is simple. Trade the level. Ignore the noise.
Powerful guidance going into the long weekend.
And here's a final thought for you to take with you. If the market aggressively ignores a clear signal of industrial slowing, that JBHT freight recession, in favor of one narrow sector's massive spending plan, what does that tell you about the real health of the global economy versus the feverish focus on the AI narrative? We're pricing out major structural risks for one single theme. What happens when that CapEx arms race finally peaks? What underlying weakness will the market have to finally reckon with then? Something to mull over.